Welcome back to Talk Tickers, everyone. This is our deep dive where we provide professional, jargon-fluent summarization and analysis of earnings calls.
Yeah, our mission is to break down these dense financial prints for the experienced investor. Find the actual signal in all the corporate noise.
Exactly. And today we're doing a deep dive into a company that, well, you might just think of as a nostalgic mall retailer.
Right, the place you went to as a kid. Build-A-Bear Workshop.
Build-A-Bear, ticker BBW. And we are looking at their Q4 fiscal 2025 earnings call. But if you think this is just about stuffing teddy bears, you are completely missing the plot here.
Oh, totally. They are in the middle of this massive structural pivot into an experiential, IP-enabled brand. It's actually a fascinating business model now.
It is, but man, we have to talk about the market reaction today because it was an absolute roller coaster.
It was brutal. I mean, management came out swinging, pitching the story of record revenues and huge global expansion.
Right. And for about an hour in the pre-market, the street actually bought it. The stock was up like over 8% before the opening bell.
Yeah, you could practically see the retail flows and the headline scanning algorithms just blindly buying the tags. Record year? Dividend hike?
Exactly. But then, 9:30 a.m. Eastern hit, the regular session opened, the human portfolio managers actually sat down and modeled out the margin compression.
And the bottom just fell out.
Completely collapsed. Within 30 minutes, it went red. And it just kept bleeding out, wiping out roughly 15% of its value intraday.
The street is just ruthlessly efficient, They are so good at separating top-line vanity metrics from bottom-line reality.
So let's invite you, the listener, to join us in unpacking this tug of war. We need to figure out if this is just a temporary digestion year for the brand, or if the cost of doing business has just permanently impaired their model.
Well, to do that, we have to isolate the Q4 numbers from the full year annualized data because the divergence there is severe.
Yeah, let's hit the Q4 print first. GAAP EPS came in at $1.26.
Which is a steep drop from $1.62 in the prior year.
Right, and it missed consensus by about 2 cents. Then you look at revenue for the quarter, which was $154.5 million.
Technically up 2.7% year over year, but still a miss.
Yeah, they missed expectations by roughly $1.8 million. Now, a top-line miss of $1 million is basically a rounding error, right?
Sure, but that EPS degradation, that immediately signals that profitability is under intense structural pressure, even when they manage to squeeze out a little revenue growth.
But management really tried to aggressively pivot away from that Q4 bleed on the call. They kept pointing to the full-year records.
Oh, of course. Look over here at the shiny object.
Exactly. They posted record full-year revenue of $529.8 million, up 6.7%.
And record diluted EPS of $3.99 for the year.
Plus, they deployed the ultimate corporate defense mechanism for a messy quarter. They hiked the quarterly dividend to 23 cents a share.
Yeah, and touted $39 million returned via buybacks. I mean, a dividend hike is usually the ultimate signal of conviction in your liquidity.
Right. Is management trying to anchor the market psychologically? Like, hey, ignore the Q4 margin squeeze. Look at our forward cash flow.
But institutional capital isn't easily distracted by buybacks when the core unit economics are deteriorating. That intraday reversal tells you everything you need to know.
You mean the smart money bailing?
Exactly. The fast money bought the pre-market headline, but the deep-pocketed managers who were actually listening to the forward guidance, they aggressively used that 8% pop as exit liquidity.
They literally dumped their bags on the algorithms.
Spot on. So we need to get into exactly what those institutional sellers saw in the spreadsheet that terrified them.
Let's do it. It starts with the absolute core issue, margin compression and the tariff albatross.
Yeah, the Q4 pre-tax income dropped to $21.5 million, down from $27.5.
And the gross margin took a brutal hit. It declined 140 basis points, down to 55.2%.
For a company whose entire historical investment thesis relies on luxury-level gross margins, a 140 basis point drop is a 5-alarm fire.
It really is. I mean, Build-A-Bear's superpower isn't the plush material, right? It's the monetization of the experience, the stuffing ceremony, the little heart ceremony.
Right. Consumers pay a massive premium for that physical interaction. Usually their gross margins look more like an elite cosmetics brand than a mall toy retailer.
But that pricing power is getting neutralized by geopolitics. Management quantified a roughly $6 million direct hit from tariffs in Q4 alone.
$6 million of pure profit just vaporized.
Poof. Gone. Didn't go to marketing, didn't go to R&D, just evaporated into trade policy friction. So they're running on a treadmill, but the motor keeps randomly accelerating.
That is a perfect analogy.
They literally have to generate record-breaking sales volumes just to tread water on the bottom line. And they did have a record Valentine's Day, but it barely helped the margins.
You can only outsell structural cost inflation for so long before consumer elasticity just snaps. And this shock is entirely exogenous.
What do you mean by that?
Well, prior to the recent trade wars, toys and plush items were largely a tariff-free import category. The whole global supply chain was built on frictionless, low-cost Asian manufacturing.
Ah, right. And now they have dynamic, fluctuating tariff rates depending on the country of origin.
Exactly. Management is forced to constantly shift production nodes between different Southeast Asian factories just to play regulatory arbitrage. It's an operational nightmare.
And even with all those gymnastics, the tariffs still shaved roughly 65 cents off their full-year EPS. That is huge.
And it isn't just the cost of getting the goods to the port either. It's the cost of selling them once they arrive.
Yeah, let's talk about SG&A. Selling, general, and administrative expenses increased to 41.4% of total revenues in Q4.
They cited a $1.2 million combined hit from increased medical expenses and labor costs.
Specifically driven by minimum wage hikes, right?
Yeah, right. So it's this brutal pincer movement on the P&L. Gross margins squeezed from the top by import tariffs, and operating margins squeezed from the bottom by healthcare and wage inflation.
And because it's experiential retail, they need a high-touch labor force. You can't run a Build-A-Bear with one apathetic teenager behind a register like you can a generic T-shirt store.
No, you absolutely can't. That high-touch requirement severely limits their ability to cut store-level hours without destroying the core product.
Which is the experience itself. So all these rising costs inevitably manifest on the balance sheet. Let's look at the inventory bulge.
Yeah, this was a glaring red flag. Inventory ended the year at $82.2 million. That's a $12.4 million increase year over year.
Now, in traditional retail analysis, a ballooning inventory figure in the face of macro uncertainty is terrifying. It usually implies a massive upcoming markdown cycle.
But management pushed back really hard on that interpretation during the call.
They did. They stated the increase heavily reflects the literal cost of the tariffs that are now capitalized and embedded in the inventory cost itself.
Along with strategic investments to support their wholesale expansion. And to be fair, counting-wise, that checks out.
Right, because the tariff is paid at the port. It sits on the balance sheet as part of the inventory value, and it doesn't hit the income statement until the bear is actually sold.
Exactly. So the physical unit counts could be totally flat, but the dollar value of the inventory spikes purely due to the tariff capitalization.
Okay, the accounting mechanics are sound, but the risk profile is what matters to you and me as investors. Are they building a massive liability if consumer discretionary spending softens?
Tying up over $80 million in working capital fundamentally limits their financial flexibility, no matter how you slice it.
They did try to mitigate concern by noting their core product is standard plush bodies. A blank brown teddy bear doesn't carry the same markdown risk as, say, a seasonal winter coat.
True. A brown bear doesn't go out of style in October. But holding that much capitalized cost requires absolute faith that the consumer will continue to show up and pay full price.
And whether that consumer shows up is highly dependent on how they are acquired. Which leads us to what I consider the most alarming structural vulnerability in this entire deep dive.
The digital channel.
Yes. The digital demand didn't just soften, it fell off a cliff. E-commerce demand dropped 13.6% in Q4.
And was down 5.5% for the full year. For an omnichannel brand, a double-digit decline in Q4 digital demand is catastrophic.
It really is. But the attribution for that decline is where this gets fascinating. Management pointed a massive amount of blame at AI-driven changes by Google.
The click zero phenomenon. This is a fundamental rewiring of how consumer intent translates into website traffic.
We have to unpack the mechanics of click zero because any investor holding a consumer discretionary stock needs to adjust their models for this immediately.
Yeah, it's actively destroying organic acquisition for direct-to-consumer brands.
Historically, a parent types best customized teddy bear gift into Google. The search engine acts as a directory, giving you 10 blue links.
Right. The parent clicks the organic Build-A-Bear link, lands on the site, and converts. That traffic was essentially free.
Exactly. But now, Google's generative AI reads the internet, synthesizes the pricing and options, and presents the final answer directly on the search results page.
The user gets what they need without ever clicking through to the retailer. The funnel is intercepted before it even begins.
The search engine is basically transitioned from a signpost pointing to the store to a digital intermediary that just hands the product data to the consumer in the hallway.
And management noted this architectural shift is causing double-digit impacts to direct click-through rates across the broader DTC ecosystem, not just them.
So how are they fighting back? They laid out a three-pronged defense. First, product schema upgrades.
Right, basically rewriting the background code of their e-commerce platform so the AI engines can crawl and categorize their products more effectively.
They are essentially fighting to be the primary source data that the AI cites. Then their second defense is leveraging user-generated content and social media.
Trying to drive intent outside of the Google monopoly, which is smart.
But the third defense is their actual structural moat. Direct email marketing driven by physical foot traffic. Management revealed they captured data on roughly 80% of the people who walk through their physical doors.
Capturing 80% of walk-in traffic data is an astronomical conversion rate. It's almost unheard of.
It really is. It allows them to completely bypass the algorithm gatekeepers and market directly to a warm leads inbox.
So the physical store acts as a massive self-funding customer acquisition engine. But we probably shouldn't let them off the hook entirely with the whole Google AI excuse.
Oh, I totally agree. Are they just using a macroeconomic tech shift to mask their own operational execution failures?
Exactly. I mean, they openly admitted on the call that sweeping IT upgrades to their legacy inventory systems delayed planned e-commerce advancements.
If your website architecture is clunky or checkout is slow, your conversion rates will plummet regardless of how much traffic Google sends you.
It's the modernized version of the dog ate my homework. Like, the large language model ate my conversion rate.
Yeah, it's incredibly convenient to blame Sundar Pichai for a 13% drop in digital sales when you were simultaneously fumbling an internal IT migration.
Regardless of the exact blame, this digital bleed forces them to lean aggressively into their physical presence and their broader strategic evolution.
Which brings us to the incoming CEO, Chris Hurt. He laid out a highly specific 4-pillar growth blueprint on the call.
The 4 pillars are organic growth of the core business, location expansion focused internationally, wholesale and brand licensing, and gifting and personalization.
Let's focus on that location expansion pillar because it involves a profound transformation in their unit economics. They are aggressively prioritizing asset-light expansion.
Moving away from the traditional corporate-owned store model, this is key.
They added 11 net new locations in Q4 and entered 8 new countries in the fiscal year. They currently operate 178 partner-operated locations,
which now make up nearly 30% of their total global portfolio. They've basically doubled that partner footprint since 2023.
This entirely alters the risk profile for investors. Historically, entering a new market meant signing a 10-year commercial mall lease.
Right, sinking massive capital into leasehold improvements, funding the payroll, and taking on all the inventory risk yourself. Highly capital intensive.
But under this partner-operated model, they're essentially licensing the operational execution to a localized entity.
The local partner takes on the heavy lifting. They fund the capital expenditure for the build-out, they sign the localized lease, and they manage the regional labor force.
And Build-A-Bear just provides the brand equity, the proprietary fixtures, and sells the physical inventory to the partner at a wholesale markup.
Plus, they likely collect a royalty stream on the top-line sales. It drastically expands their return on invested capital.
Because the denominator in that equation, the capital they personally have to invest, is compressed to nearly zero.
Exactly. They get the brand impression and the revenue stream without the lease liability.
They specifically highlighted a highly successful re-entry into Germany with 4 standalone stores, alongside 15 thriving partner locations in Italy.
When your domestic U.S. margins are being compressed by labor inflation and specific import tariffs, rapidly migrating 30% of your footprint to an international asset-light structure is a massive geographic hedge.
It's arguably the most structurally sound strategic initiative they have. But their third pillar, wholesale and intellectual property, introduces some real brand equity risks.
This is the kidult demographic play.
Yes. Management is aggressively monetizing the fact that teenagers and adults are now a massive growth cohort for plush collectibles.
They launched a product line called Mini Beans, which are smaller, pre-stuffed collectibles, and they've already moved over 3 million units.
Over 3 million units. But because the mini beans are pre-stuffed, they completely bypass the core in-store stuffing machine experience.
Which is an operational efficiency that allowed them to secure a massive Q4 wholesale order. They dropped these branded mini beans onto end caps in approximately 1,500 Walmart locations.
And they are building an entire media ecosystem to support this IP transition. They launched a YouTube animated series called Kaboo.
Right, featuring proprietary characters. That series drove over 1 million views, which translated almost instantly into $1 million in character plush sales.
They are actively attempting to transition from a retailer that merely distributes third-party IP to a media-adjacent company that originates and monetizes its own IP.
They also noted their co-branded Hello Kitty and Friends workshops are significantly outpacing internal projections.
But I have to push back on this Walmart wholesale deal. It presents a massive strategic contradiction.
You think it dilutes the brand?
Absolutely. If you put your product on a cardboard display in 1,500 Walmarts, do you irreparably dilute the premium experiential moat you spent 30 years building?
I see your point. The pricing power relies on the concept of the destination.
Right. You don't just buy a bear, you invest an hour of your weekend into an entertainment experience for your child. The transaction is secondary to the memory creation.
But management's counter-argument is that the wholesale channel acts as a highly lucrative top-of-funnel marketing mechanism.
Yeah, but if a parent can just toss a branded mini bean into their cart while buying paper towels at Walmart, it completely cannibalizes the dedicated trip to the mall.
Management views it as a billboard, though. It creates brand awareness and initial trial, which they think ultimately funnels the consumer back to the premium workshop.
The classic hub and spoke model.
Exactly. The wholesale distribution acts as the spokes, capturing peripheral attention, while the highly immersive experiential flagships act as the hub.
And their vision for the ultimate hub is the upcoming Icon Park flagship in Orlando. They teased this heavily on the call.
It sounds massive. A multi-level next-generation store opening right in the epicenter of global tourism.
They are installing a high-end design studio with personal consultants, a branded experiential bake shop, an outdoor rooftop entertainment space.
And a customized scent bar. They aren't trying to compete with the local mall toy store anymore. They are explicitly aiming at the pure experiential giants.
Designing a flagship with a bake shop and a rooftop space in Orlando signals an ambition to replicate the models perfected by Disney and Universal.
And a location like Icon Park operates with entirely different unit economics. The goal isn't necessarily four-wall profitability optimization.
Right. The goal is brand elevation, global media impressions, and creating a halo effect over the entire international portfolio.
Tourists experience the pinnacle of the brand in Orlando and then seek out the localized partner-operated stores when they return to Germany or Italy.
But executing an experiential flagship of that magnitude while managing an international franchise rollout and a volatile supply chain requires flawless operational leadership.
Which brings us to the major governance headline released alongside these financials. CEO Sharon Price John is retiring after 13 years.
Her legacy there is undeniable. She engineered a textbook retail turnaround.
She really did. She took the company's pre-tax margin from effectively 0% up to nearly 13% at its peak.
She navigated the retail apocalypse of the mid-2010s, steered them through the pandemic lockdowns, and rebuilt the balance sheet.
They generated enough free cash flow under her to retire 25% of the company's outstanding shares. She fundamentally saved the equity from going to zero.
But now the baton is being passed. Following a transition period, the current COO, Chris Hurt, will assume the CEO role in June 2026.
Promoting the COO, specifically the executive architect responsible for the international expansion and the global supply chain, is the board signaling absolute strategic continuity.
They are stating clearly that the current playbook is the correct one, and they just need the primary operator to continue running the plays.
Continuity provides stability, but you really have to read the room here.
Yeah, the market's brutal intraday reaction suggests investors might have wanted something else.
They might have been quietly hoping for an external hire who would initiate an aggressive, margin-focused pivot.
When your gross margins are actively compressing by 140 basis points, institutional capital doesn't want to hear visionary pitches about rooftop bake shops.
No, they want to hear about ruthless cost-cutting, supply chain optimization, and immediate pricing power initiatives. They wanted a wartime CEO.
And instead, they got the architect of the current expansion strategy. That show-me approach from investors is entirely tethered to the forward guidance.
Let's break down the FY 2026 tug of war, because the mathematical realities within this guidance are what ultimately broke the stock's momentum.
The forward guide is a jarring study in contrasts. Top-line projections remain optimistic, with management forecasting mid-single-digit revenue growth.
However, the bottom line guide is severe. They project pre-tax income to range anywhere from a mid-single-digit decline to, at absolute best, low single-digit growth.
They are explicitly telling the market that they will sell more goods, but potentially make less total money doing it.
And they quantified the exact weight of the anvils dragging down that profitability. They are modeling a massive $16 million full-year estimated impact from tariffs.
$16 million. On top of that, they are absorbing an additional $3 million in strategic investments tied to the Walmart rollout and the Icon Park capex.
So you are looking at $19 million of combined headwinds applied against a company that generated roughly $67 million in pre-tax income for the entire fiscal year.
Nearly a third of their baseline profitability is being consumed by geopolitical supply chain geometry and growth capex.
However, the CFO provided a highly specific timeline for how these costs will hit the P&L, creating a crucial calendar dynamic, the H1 versus H2 split.
Right. Based on the flow of their capitalized inventory, they project an $8 million incremental tariff cost hitting directly in the first half of 2026.
But because they anticipate shifting tariff rates and highly favorable comparables against the prior year, they actually expect a $3 million structural benefit in the second half.
So the financial pain is intensely front-loaded into Q1 and Q2.
This specific dynamic perfectly mirrors the broader bifurcation in the global retail sector right now.
How so?
Well, experiential retail consumers paying for memories and interactive events remains highly resilient. But traditional discretionary retail, just buying commoditized goods, is being crushed by freight, wages, and tariffs.
And Build-A-Bear is trapped perfectly in the center of that Venn diagram. The core product is experiential, which gets them record sales.
But their underlying supply chain is purely traditional discretionary, subjecting them to the exact same margin-crushing forces as a generic fast fashion brand.
It sets up the ultimate investor dilemma. Management is selling a multi-year IP-driven growth transformation. But the algorithmic trading engines are evaluating the tape strictly as a near-term margin story.
And the algorithms will aggressively short a Q1 earnings decline, regardless of how profitable the Orlando flagship might be in Q4.
Over a 3 to 5 year investment horizon, the strategy to diversify into wholesale and expand internationally is fundamentally sound.
But equity markets dictate valuations in the immediate term. Absorbing a front-loaded tariff hit while funding an aggressive capex cycle is going to make the first half P&L look highly distressed.
The market's decision to re-rate the multiple downward is a completely rational mathematical reaction until the new CEO proves he can out-earn his own structural costs.
Which brings us to the segment where we apply all of this data.
Yes, this is not financial advice segment. I have to explicitly state, this is not financial advice. Do not trade off this.
Strictly an intellectual exercise. We are operating like two analysts pitching provocative, entirely hypothetical trade ideas to an investment committee.
Based purely on the data points we just unpacked. So what is the first structural play?
Trade idea 1, the H1-H2 tariff calendar spread.
Okay, lay it out.
This pitch relies entirely on the CFO's explicit guidance regarding the timing of the tariff pain. We know the $8 million hit is violently front-loaded into the first half of the year.
And the market is a reactionary, backward-looking machine.
Exactly. When the Q1 and Q2 earnings prints hit the tape and show severe margin degradation, the algorithms will likely overextrapolate that pain into perpetuity,
Punishing the stock and potentially driving it down into deep value, oversold territory. So you are anticipating peak pessimism following the Q2 print.
You let the blood run in the streets during the first half of the year. Then you execute a back-half-weighted options strategy.
Step in and buy long-dated calls or structure a calendar spread specifically targeting the Q3 and Q4 expirations.
Right, because in the second half of the year, 3 massive catalysts converge simultaneously.
First, the brutal tariff math flips from an $8 million headwind to a $3 million tailwind.
Second, the massive Icon Park flagship opens, generating a wave of global PR and tourist foot traffic.
And third, The revenue from the 1,500 Walmart locations begins aggressively hitting the top line, right as Chris Hurt takes full control as CEO and wants to post a blowout first quarter.
You are betting on the market, over-punishing the near-term squeeze, creating a massive asymmetrical upside in the back half when the comps become incredibly easy.
It is a classic time arbitrage play. You allow the short-term traders to create a severe mispricing and step in right before the fundamental narrative violently flips.
It requires extreme patience, precise timing, and the stomach to watch the underlying equity bleed for 6 months. But the underlying logic is structurally sound.
I love it. Now for trade idea 2, the adult arbitrage pairs trade.
Let's hear it.
For this setup, you are going long on Build-A-Bear and short a generic low-IP mall apparel retailer. Think of any legacy fast fashion brand struggling with cultural relevance.
Or simply short an equal-weight broad retail ETF. The core thesis relies on the divergence of pricing power.
Exactly. Both the experiential IP brand and the generic apparel brand source their physical goods from overseas.
They both face the exact same macroeconomic headwinds. Ocean freight spikes, minimum wage hikes, identical import tariffs.
Their cost of goods sold is rising in tandem across the exact same logistical routes. However, they have entirely different mechanisms to defend their operating margins.
Build-A-Bear relies on the inelasticity of the adult collector demographic.
Yes, the pricing power of the adult trade. An adult collector will absolutely pay a 10 or 15% premium for an exclusive Hello Kitty drop.
Or a limited edition Pokemon release without blinking. The emotional connection to the IP makes the consumer largely price inelastic.
But the generic apparel retailer is selling commoditized basic t-shirts. They have zero pricing power.
If they try to raise prices by 10% to cover the new tariffs, the consumer simply walks across the mall to a competitor or buys it cheaper online.
The thesis implies that the IP-heavy brand can systematically out-earn the inflation through strategic price hikes without destroying unit demand.
While the generic retailer will see their margins permanently destroyed because any attempt to pass the costs along results in an immediate volume collapse.
You neutralize the macro supply chain risk by going long and short in the exact same sector, and your pure alpha is derived entirely from the difference in consumer price elasticity.
It's an elegant pairs trade. The primary risk factor is the assumption that the adult consumer is truly inelastic.
True. If a severe macroeconomic recession materializes, customized plush toys might get cut from the household budget long before basic apparel does.
But as a structural play on IP monetization versus raw commodity retail, it is a highly compelling setup.
It's the ultimate test of brand equity in a high inflation environment. We are looking at a company that successfully achieved record top-line growth, only to see that growth violently collide with geopolitical supply chain costs.
Management is executing a textbook transformation, migrating toward an asset-light, IP-driven model.
But the market refuses to pay a premium multiple for a forward-looking vision when the current year margins are deteriorating under the immediate weight of tariffs.
A fundamental mismatch of time horizons between corporate operators and institutional traders.
Well, before we wrap up this deep dive, I want to leave you with one final provocative thought to mull over.
Building on that click zero phenomenon we dissected earlier.
Exactly. If generative AI continues to essentially destroy organic search traffic, if direct-to-consumer brands can no longer rely on Google to cheaply drive targeted intent to their websites.
What happens to the intrinsic value of physical retail real estate?
Yes, it completely inverts the traditional customer acquisition model. Will legacy brick-and-mortar brands with massive foot traffic suddenly find themselves with a huge customer acquisition advantage?
Over pure-play e-commerce brands, it's highly likely. If digital ad rates skyrocket and organic search is dead, maybe the cheapest way to acquire an email address isn't through a complex digital funnel.
Maybe the cheapest acquisition tool is simply having a bright, noisy, experiential storefront where millions of people are already walking by.
It suggests that physical rent in high-traffic areas is rapidly becoming the new digital ad spend.
And a company capable of capturing 80% of their in-store customer data might be sitting on a proprietary data goldmine that the market hasn't even begun to fully value yet.
Something to carefully consider as you review your own portfolio's exposure to skyrocketing digital marketing costs and incoming tariff headwinds.
Remember, nothing we discuss today is financial advice. We are simply analyzing the tape and the structural realities of the market.
Thanks for joining us.
Yes, thank you for tuning in as we unpack this incredible narrative collision. Join us next time for more Talk Tickers coverage, where we will continue to strip away the corporate spin and find the actual truth in the numbers.